A venture capital trust, or VCT, is a tax-advantaged investment vehicle designed to help small, high-risk companies grow in the United Kingdom. VCTs pool money from many investors to buy shares in smaller, unlisted businesses that are often in their early stages of development. The primary draw for many is the potential for significant income tax relief, which helps offset the inherent risks of small company investing. Beyond tax relief, VCTs offer tax-free dividends and capital gains, but remember that these investments carry a much higher risk than blue-chip stocks. VCTs differ from standard stocks because they target unlisted, growing companies, making them less liquid than shares you might trade on an exchange. As this chart shows, VCTs occupy the highest end of the risk spectrum. They are intended for investors who can tolerate potential losses. Always look at the underlying business quality first. Tax incentives are a bonus, not a replacement for a solid investment strategy. VCTs are complex tools. Consult with a qualified advisor to see if they align with your portfolio. Thanks for watching and stay informed.